Does the thought of investing in the stock market scare you? Don't worry, you are not alone. The market is filled with risks. It's not surprising that the pendulum of investment is said to be swing between the fear and the greed. To reduce the fear of anything, all we need to do is understand it better. But before that, do not forget to subscribe to our channel if you haven't already. This is Thoughtctrl, and today we are going to talk about stocks. What is a stock exchange? How do stock exchange work? Investing in the stock market is rarely not risky, but if handled efficiently, it can be one of the best ways to build up one's net worth.
Most of the very rich generally have the majority of their wealth in the form of stocks. Let's see what stocks really are. Shares or stocks of a company represent ownership equity in the firm. It basically gives the shareholders voting rights as well as claim on the earning of the company that they get in the form of dividends.
Being a stock owner means that you own a slice of the company, equal to the number of shares you have in proportion to the company's total shares.
For example, if an individual owns 1 lakh shares of a company with 10 lakh outstanding shares, it would have 10% ownership stake in it. Most companies have outstanding shares that run into the millions or even billions. Stock markets are a place where individuals or institutions come together to buy and sell shares.
Nowadays, the market exists only digitally. But the first stock market appeared in the Europe in the 16th and 17th century.
Mainly in port cities that became trading hubs such as Amsterdam or London. With the emergence of the East India Company, the emergence of various East India companies that issued stock led to financial boom.
But you can say that these early stock exchanges were more like bond exchanges, as companies did not issue equity. In fact, the most early corporations were semi-public organizations, meaning that they were required to be under some kind of government control.
Nonetheless, it led to a financial boom that was soon followed by a crash when it came to the public attention that some of these companies conducted very little actual business.
But if you want to look for the true motivation behind the idea, you can find it as early as the 1300s.
At the time, Venetian moneylenders began trading debts between each other. A lender looking to unload a high-risk, high-interest loan could exchange it for a different loan with another lender. As time passed by, the lender began to sell debt issues to the individual investor. And then by the late 18th century, stock markets began appearing in America. The NYSE was founded in 1792. Before this official opening, traders and brokers met unofficially under a buttonwood tree on Wall Street to buy and sell shares. Today, there are many stock exchanges throughout the world, most of which are linked together electronically, which in turn make the market more efficient.
But who decides the share price? Well, market does. Share prices are set by the main forces of the market, that is, supply and demand. So it fluctuates as buyers and sellers place orders.
The overall market is made up of millions of investors and traders. They all have different ideas about the value of a specific stock, whether they want to buy or sell. Thousands of transactions occur as these investors and traders buy or sell a stock. This causes minute-by-minute variation in price over the course of trading day.
As we already talked about, this happens on the platform of a stock exchange, and or the average person to get access to these exchanges, they would need a stockbroker.
As for every stock transaction, there must be a buyer and a seller. If there are more buyers for a specific stock than there are sellers of it, the stock price will go up. Similarly, if there are more sellers of the stock than buyers, the price will go down.
Why does a company issue shares?
Think of today's tech giants like Alibaba or Facebook. They were all started by visionary founders from a small single room, and that was just a couple of decades ago.
Growing at such a speed requires a massive amount of capital.
A startup can raise such capital either by selling shares or borrowing money. Interest on loan can be heavy burden for a new company.
And that's why equity financing is the preferred route for most startups whose capital needs becoming more substantial once they have expanded a little.
To sell its equity to the public, a company needs to go through an initial public offering. This changes the status of the company from a private firm to a publicly traded company. Once the company's shares are listed on a stock exchange and trading in it commences, the prices of these shares will fluctuate.
Another thing to understand is that stock exchanges are secondary markets. It is where existing owners of shares can do transactions with new potential buyers. Companies listed on the stock markets rarely buy and sell their own shares,
unless it's engaging in stock buybacks or issuing new shares. But these are not daily operations and sometimes even occurs outside of the framework of an exchange. So if you go and buy a share on the stock market, you are not buying it from the company. You are buying it from some other existing shareholder.
Likewise, when you sell your shares, you do not sell them back to the company, but to some other investor. That's all for today. Thanks for watching this video. If you have any feedback, please let us know in the comment section below. And do not forget to share and subscribe. Bye bye, hasta la vista, tata, see you. अपना टाइम आएगा, नंगा ही तो आया था, तू घंटा लेके जाएगा. अपना टाइम आएगा ना, अपना टाइम आएगा ना, आएगा. बाहर